All right, let's dive into one of the most misunderstood events on the entire trading calendar, the central bank interest rate decision. For most traders, it's just pure chaos. But for us, by the end of this, it's going to be a structured, high-probability setup that can literally define your entire trading week. Let's get into it.
This quote right here, it just hits the nail on the head. So many traders look at a rate announcement like it's some unpredictable storm. A flash of lightning on the chart that either blows up their account or, if they're lucky, hands them a win. But that whole reactive mindset, well, it misses the entire point.
Because here's the fundamental shift in thinking you have to make. A central bank's rate cycle isn't just some background noise for the price action. It is the price action. Seriously, every single sustainable multi-week trend you see on a chart has a story about interest rates driving it. Once you really get that, you stop guessing and you start reading the market's actual roadmap.
So, if the rate cycle is the roadmap, what's the engine? Well, it all comes down to one really powerful concept, the one that drives the institutional money that really moves these markets.
Okay, this right here, this is the single most important concept for any trend trader, the interest rate differential. Forget about the absolute rate for a second. It doesn't matter if one currency has a 5% rate and another has 2%. What matters is the gap between them, and even more importantly, whether that gap is getting wider or getting narrower. That, my friends, is the engine.
What's so powerful here is how this concept translates directly into how the market behaves. When that rate gap is widening, the big institutions run something called a carry trade. Basically, they borrow the currency with the low interest rate for cheap, and they use it to buy the currency with the high interest rate, and they just pocket the difference. That flow of big money is what creates those clean, sustained trends we all love to trade. When the gap narrows, that trade unwinds and the trend reverses. And if it's flat, well, the big money isn't playing. The market just chops sideways, and we should probably stay away.
So we have our big picture framework, the why. Now let's build our tactical plan, the how. How do we take all this knowledge and actually apply it to the high-impact event of a rate decision on Wednesday?
So the market's reaction is generally going to fall into one of three buckets. A hawkish surprise, which just means the bank is more aggressive about raising rates than expected. That gives us a strong reason to look for buys. A dovish surprise, where they're less aggressive, gives us a reason to sell. But look really closely at the strategy here. In both surprise cases, the plan is to buy the dip or sell the rally. We are explicitly not chasing that chaotic initial spike. We're letting the dust settle.
And here is exactly why we wait. The secret is the actual rate hike or cut is almost always priced in weeks in advance. The professional money isn't trading the headline number, they are trading the language. They're listening for clues about what's going to happen at the next 3 meetings. Things like, we may need to raise rates further, or we are proceeding carefully. Those are the real signals that dictate the trend for the weeks to come.
Okay, now for the actionable playbook. The rate decision is done, the dust is settled, it's Thursday morning. What do you actually do? Here is your 5-step checklist.
Step 1, mark Wednesday's reaction high. That's your line in the sand. Step 2, look for confluence. Does that high line up with another key level, like a previous week's high or a big pivot point? That just strengthens the zone. Step 3, watch what happens in the overnight session. We want to see price hold above that level, showing us the market accepts this news story. Step 4, manage your risk. We size for tail risk, that small chance of some follow-on news, by taking a slightly smaller position, maybe 60–70% of normal. And finally, step 5, this is crucial. Your stop loss goes at a price that proves the narrative wrong. It's not just a random number. It's the point on the chart where you have to say, okay, the market is telling me the hawkish story is over.
All right, theory is great, but let's see how this actually works in the real world. We're going to walk through a classic example of a hawkish surprise and see how our checklist gets us into a really high probability trade.
So the scene is set. It's 2 p.m. on Wednesday. The central bank was expected to hold rates, but they either deliver a surprise hike or they hold but use really aggressive language about future hikes. The currency just screams higher.
And this just perfectly illustrates the typical sequence of events. That Wednesday spike breaks a really clear resistance level. Then, during the quiet overnight session, some profit-taking causes price to drift back down to that exact level. By Thursday morning, we see price testing that old ceiling, which should now, in theory, act as a new floor. This is the moment of truth.
So the big question for us is, does this Thursday morning setup tick all the boxes on our checklist? We have the reaction high, we have the overnight pullback to test it as new support, the market has validated the new story. The answer is a clear yes. This is the textbook entry we were patiently waiting for all along.
But let's be real, no strategy works 100% of the time. A truly professional approach isn't just about finding good entries. It's about knowing when the core reason for your trade, that macro narrative, is just no longer valid.
Two things can absolutely kill this trade. First, a major risk-off event. Think global panic. In that kind of environment, nobody cares about interest rates, they just want safety, so they dump riskier currencies and unwind the very carry trades that were driving our trend. The second killer is a bit more subtle. It's when the market starts pricing in the end of the rate hikes. Even if the gap is still wide, if the market believes the next move is a cut, the trend will die. You always have to remember, the market is trading 6 months into the future.
For those risk-off events, here's a simple, powerful rule of thumb you can use. When the VIX, which is basically the market's fear gauge, spikes above 25, it signals extreme fear. In this environment, rate differentials take a back seat to just preserving capital. All rate-driven trades are put on hold until things calm down, period.
And this brings us right back to the core philosophy of this entire approach. You start with the macro story. Where are the central banks in their cycles? Is that rate differential widening or narrowing? That tells you the direction. Then, and only then, do you pull up a chart and use your technical tools to find a precise entry and exit.
So I'll leave you with this question to think about. Take a hard, honest look at your own trading framework. Is it built on the market's fundamental engine, or are you just reacting to its noise? Answering that honestly could change everything for you.